Right now, nearly half of all the Bitcoin in existence is trapped. It hasn't moved since the price was higher than it is today. That amounts to roughly 45 to 46% of the entire circulating supply. This visualization shows the total circulating Bitcoin supply. When we map out that percentage, we are looking at nearly 9 million individual Bitcoin sitting in a state of unrealized loss. A supply freeze of this magnitude represents a rare structural extreme. The historical data shows a clear rule. Whenever the market crosses this specific threshold, it does not resolve passively. The structure either fractures, triggering a capitulation event of cascading liquidations, or the market absorbs the pressure, initiating a late-cycle accumulation phase. Currently, Bitcoin is consolidating in a narrow channel between $65,000 and $66,689. To determine if this channel will break up or down, we have to look past the passive underwater holders and isolate the active institutional sell-side variables. This chart tracks a metric called supply in loss. When we move the timeline back to mid-2018, we see a massive spike crossing the 45% threshold. That high reading signaled immense pressure in the system, and it preceded an immediate structural collapse. Bitcoin took a 50% plunge straight down to the $3,200 low in December of that year. Moving forward to mid-2022, an identical spike appears above that exact same threshold. This time, it triggered a structural grind down to the $17,500 capitulation bottom. But January 2023 presents an anomaly. The indicator spikes again, yet the price line stabilizes and climbs. The 45% threshold fired exactly as it did in 2018 and 2022, yet the market recovered without a secondary washout. In 2023, large active sell-side pressure had already exhausted itself prior to the signal firing. The data shows that massive underwater supply acts as a primer. It detonates into capitulation only if forced sellers are still actively driving the market. To see if sell-side pressure is exhausted today, we need to analyze current market flow data. Starting with Wall Street, we can track the capital flight from spot Bitcoin ETFs. This chart shows ETF flows dropping heavily into the negative, hitting $3 billion in net outflows year to date. Last week alone, these participants offloaded over 600 Bitcoin every single day. These specific investors are locked into a bearish stance by a mathematical trap. Their average entry price sits at $83,956. That creates a persistent 23% paper loss for this entire institutional cohort, fueling constant selling pressure. We also need to check on-chain whale behavior to see if large native holders are accumulating to counteract that Wall Street flight. They aren't. Whales shed over 43,000 Bitcoin in a single week. This activity suggests that today's landscape is defined by aggressive, coordinated distribution from both Wall Street and legacy whales seeking exit liquidity. On-chain analysts use a metric called realized price to find the true absolute cost basis of specific groups of holders. This realized price alters the market's mechanics. When the spot price falls below a cohort's cost basis, their former support level turns into overhead resistance. If we isolate the 1-month holder cohort to map the first layer of resistance, a heavy ceiling drops in directly above the current price. That 1-month realized price is locked at $69,000. Next, we map the 1 to 3-month holder cohort to find the secondary, heavier layer. Their realized price creates an immense ceiling near $90,000. The immediate downside risk rests on a structural floor at $63,000. The market is currently trapped in compression between that $63,000 floor and the $69,000 ceiling. Analysts at Glassnode note that this structure forces persistent loss realization into rebounds. Every time the price ticks up, underwater holders sell to break even. This continuous, slow drip selling is exactly what prevents a cathartic panic volume blowout. It causes the slow grind we've seen down from the October all-time high. This heavy cost basis overhead makes organic upward momentum difficult. The market requires an external force to shatter those ceilings. We can measure macro market stress using the check-on-chain Bitcoin Impact Index. The dial currently points to 57.4, deep inside the high-impact zone. Reaching this level historically acts as a precursor to outsized price moves in either direction. The bear case trigger is a daily close breaking the $63,000 support floor. Breaking that level automatically initiates mathematically guaranteed forced liquidations from shorter-term holders. To trigger the bull case, buyers must completely overpower the current 43,000 Bitcoin per week whale offloading. The exact metric required to validate this is weekly ETF net inflows crossing above $1 billion. Only a capital injection of this magnitude can reclaim the resistance and restart the cycle. 6 unbroken months of bearish conditions almost never resolve without a shock event. Until a billion-dollar wave of liquidity arrives, the market is bleeding out, inching closer to the market-wide liquidation event it has managed to delay.